Hello, welcome again to FAIRtax Power Radio. I'm Bob Paxton.
And I'm Bob Scarborough.
And we are the FAIRtax Guys, complete with my dodecahedron Megaminx Rubik's Cube type puzzle for you today.
I brought the scrolling banner, but I know it's not going to show up in the technology.
That's tough on this virtual background, but we got it. But let's kind of jump right in today. We will forego our usual Congress.gov segment till next week, because those of you watching in the video format can see we have a guest with us in the center chair. His name is John Richardson. He is an attorney that is living in Toronto, Canada right now. And we're going to discuss an issue that really doesn't come up a great deal when you look at the overall entirety of the FAIRtax movement, because it affects a relatively small number of people. But the people that are affected are greatly affected. And we're talking about American citizens who are living outside the United States in other countries. And Bob, I think you've got a little experience with that in your family, do you not?
Well, yes, a family member has dual citizenship in another country, further away than Canada. But as the crow flies, it doesn't make a whole lot of difference. I guess if you're out of the country, you're out of the country. And I guess that's right, John. It doesn't really matter where you are, as long as you're on the other side of the border. The challenges are there for folks that live outside the United States who have citizenship here.
All right, John, well, let's go ahead and dig right in here and define the problem that we're talking about. So in as much detail as you need to, describe what the current tax system does to American citizens living abroad.
Well, I'll start with a conclusion and then explain how I get there. Basically, it's forcing them to renounce their U.S. citizenship, is what it's doing. Now, how do we get there? Well, we get there because the United States is unique in the world in employing what, if you're in favor of it, you might call citizenship-based taxation. And if you're opponent of it, you would see it as imposing U.S. rules of worldwide taxation on people who are actually tax residents of other countries, meaning that they're completely subject to the tax systems of those other countries. So that's the starting point. Second point is that the income tax, which you want to get rid of, I encourage that, is basically hostile to absolutely anything that is not U.S. centric. In other words, anything that is foreign. In fact, if you look in the Internal Revenue Code, which is, of course, incomprehensible to everybody in the world.
Yes. Which page of the 70,000 plus pages are you referring to?
Jump in anywhere.
Okay, go ahead.
If you see the word foreign, you are almost certain to see the word penalty before or after within about 10 words, okay? Usually starting at $10,000, unless it's a foreign trust type of issue or something like that. And the thing is, the penalty provision can really be easily understood. It scares people out of their minds. What's not clear is exactly what they're going to get the penalty for, because nobody can understand what's even required of them. But the bottom line of it is that because the U.S. tax code is written in a way that imposes punitive taxation on kinds of income that are very normal and pedestrian in the country where people live, and massive penalties for failing to report things that they don't even understand what they're being asked to report on, creates a situation where, first of all, they don't know what's required of them. Secondly, they're subject to two different tax systems. Let's take Canada, since it's where I live, Canada and the United States examples. Thirdly, because as you know, so much of income tax legislation in the 21st century has nothing to do with taxation, but has to do
with we know that quite well.
Yeah, et cetera, et cetera. So what happens is that the United States effectively disables citizens who live outside the United States and are subject to other taxes and from actually getting the benefits of those tax systems, right? So to give you a few trivial, well, they're not trivial if you're simple. I'll use the word simple, not trivial.
Okay.
Simple examples. In the U.S., there's a Roth IRA. You know that's basically a tax-free thing. Canada has something that is, as far as I'm concerned, conceptually the same idea, called a TFSA, a tax-free savings account. And that's, of course, not recognized in the Internal Revenue Code. So if a U.S. citizen is living in Canada and wants the same benefits of that normal kind and important part of retirement planning in Canada, that U.S. citizen would be disabled from it, more or less, because the U.S. would not recognize his tax deferred status and would simply tax the income. A second example might be for middle class people, mutual funds are a normal way of investing, right? So let's take something like Templeton Growth Fund, or what's it called now, Templeton Franklin. I live in Toronto. You could buy it in Toronto. You could drive 2 hours and buy it in Buffalo. You buy it in Buffalo, it's not foreign. You buy it in Toronto, it's foreign, which means it's subject to a punitive taxation regime called the PFIC regime, which basically confiscates the gains, etc.
You're talking about the same investment product in both cases, correct?
Exactly the same investment product. Exactly the same investment product.
It just depends on which zip code you set it up in, I guess, or which country.
Which country code? Which country code? Where you're resident, where you buy it. So you go buy it. You live in Canada. You buy it in Canada. It's going to be a PFIC. Okay, if you buy it in the U.S., it's not going to be a PFIC. But you've got the problem that Americans abroad have of not being able to buy things in the U.S. because of things related to the Patriot Act, et cetera. And I'll give you a third example that's very, very common is this, that different countries have different ideas about retirement planning. Obviously, they have different things to incentivize retirement planning. And the sale of a principal residence, the capital gain is not taxable in Canada or in the UK, in many other countries, and wasn't in the US, by the way, until, sometime in the 90s, right? Where they made this change. So you have a situation where, and I know there's a $250,000 exclusion. I'm well aware of that, okay? But, with what's happened to real estate, if you've held something for 20 years, it's not going to make an awful lot of difference. So you have a situation where, for Canadians, a mainstay of their retirement planning is the principal residence. They will buy, pay this off. By the way, there's no interest deduction on mortgage in Canada either. So this is major, all right?
Right.
Then what they'll do is they'll sell and they'll move to a less expensive part of the world to live in. But of course, if they're U.S. citizens, well, they're going to lose a big part of that in the gain, which makes U.S. citizens abroad, for that reason, permanently economically downwardly mobile people, right? I mean, they don't have the same opportunities that other people do. I'll give you a fourth example, and then we'll move on. But I think this one is so important. Going back to my description of how different countries have different ideas of retirement planning. Well, all three of us know that pensions may have been the name of the game in the last century. It's pretty hard to get a pension in the 21st century, right? So it's fend for yourself. And one of the ways that works in Canada is, and Australia, other countries, is through the creation of small business corporations. People run their sole, what might be a sole proprietorship in the U.S., a doctor's medical practice, it could be a pizza delivery business, a laundry business, what have you. But the point is, very pedestrian businesses. For tax reasons in Canada, they run them through these small business corporations because that's how you map out retirement planning in Canada. But, oh my God, if they're U.S. citizens, all of a sudden they've got a CFC, controlled foreign corporation, just like Apple, just like Microsoft, etc. And they lose the benefits, presumptively. I mean, there are technical workarounds, but I mean, in some cases, but they lose the benefits that are provided by the Canadian tax system. So really, what happens is that to be a tax compliant American abroad, you have to make a choice between the responsible financial and retirement planning that all people in the 21st century are obligated to engage in, or your U.S. citizenship. And guess what? It's a no-brainer. They've got to get out of it to survive. So people are renouncing U.S. citizenship, not because they don't want to be U.S. citizens, but because they're being actually forced out of their citizenship as a matter of survival. Anyway,
how many people has that happened to?
Well, how many?
I know you don't have an exact number there, but just an estimate.
I don't have an exact number, but I mean, there are tens of thousands of people are renouncing. And there's a lot of people who I don't believe are in the U.S. tax system, because one of the things I've noticed from, helping people over the years is that, entering the U.S. tax system for these people, most of them don't even know about, citizenship tax. They're just living their lives, right? Mm-hmm. But by entering the U.S. tax system, it's usually the first stage towards renunciation.
Is it planned that way, or is it just because the tax code in the United States doesn't really take into consideration the particular situation that someone who lives in another country has? In other words, it's not somebody sitting there at the Treasury going, we need to get these people out. It's just a reaction to a really messed up system.
Yeah, it's a reaction to a messed up system. There's nobody at Treasury, thinking about getting these people out, because there's nobody at Treasury who thinks about the fact that the U.S. tax code applies to U.S. citizens abroad. I mean, in the United States, I suspect that I would be willing to bet that over half the tax preparers don't even know that citizenship tax exists, or they equate citizenship with residency. And of that half that do, I bet you 80% of that half don't even really know how it applies. And the large number of penalty-laden forms that, people are supposed to be filing. I mean, in the description I gave you, I mean, here are some extremely penalty-laden forms that would be included in that. Form 8938, 5471, the 3520, the 3520A, the FBAR 5. I mean, these things are potentially 100,000 of penalties a year.
Wow. Now, how would the IRS or the Treasury Department or whatever go about collecting that penalty from someone who's not living in the United States? How enforceable is that?
I don't know. I don't know the answer to that question. I suspect it depends on the country, and it clearly depends on the treaty. Now, historically, there's a common law rule which has also been adopted by the United States called the revenue rule, which is that historically, you can't, no country can use the courts of another country to collect tax debts. But now let's be clear here. The U.S. is the only country that employs citizenship-based taxation. So the U.S. is the country that is probably the most upset about the revenue rule, right? Because it defines tax residents of other countries as their own tax residents, okay?
Okay.
So they've started a new brand of treaty, which basically is a mutual assistance treaty to get the tax administration of the other country to collect on these people. But the carve out is that they won't collect on people who are citizens of their own country. So that's a mouthful. So for example, practically, you're a dual Canada-US citizen living in Canada, all right, under the Canada-US tax treaty, although there's a general mutual assistance collection provision, it would not apply to somebody who was a citizen of one of the countries at the time the tax debt arose. So I think at the moment, probably difficult to collect. But, today is one thing, right? How these things unfold as time goes on is another. I mean, we've got FATCA now. I mean, I would not be having this conversation with you if we were to go back to, say, 2009 even. We would not be having this conversation, because there was no FATCA, there were none of, there wasn't this publicity about, the Swiss banking thing somehow dragged normal middle-class Americans abroad into this as presumptive tax cheats. I mean, it is totally insane, because a lot of these people, no matter what, don't actually end up owing U.S. tax. for a variety of technical reasons. But they're still locked into something where they're paying, tons of money to have to file these tax returns. And, where the problem can be is the penalties for the foot faults on the forms.
Wow. So they make the system so complicated you can't figure it out, and then they penalize you for not doing it right. Is that a fair assessment?
That is a perfect assessment. And I would add that the system is so complex that I would bet my last dollar that the only Americans abroad who are truly compliant with their U.S. taxes are those who are not required to file because they don't meet the minimal income requirements. Now you've got compliance. Anything they send in is likely to have foot faults. And by the way, just to show you how insane this has gotten. So, if an American citizen lives outside the United States, as we all know, it's common for people to marry, right? To have a spouse. Well, if they have a spouse who's not a U.S. citizen spouse, there's a very, very good chance that they're going to be using the married filing separately category, right? Because, I would have to think that absent a really good reason, it would put an awful strain on the marriage to wake up and say, I think it's time you join me in the U.S. tax system.
Right.
This sort of stuff, right?
When they stop laughing.
Yeah. But one of the changes that was an inadvertent accidental effect of the 2017 Tax Cuts and Jobs Act was, are you ready for this? Now, under the Internal Revenue Code, if you're married filing separately, you have to file with zero income. All right. Now, the IRS, in its graciousness and understanding, had the good sense to raise the threshold to $5.
Hey,
just to make sure that somebody who had zero income really didn't have to file. But this is the insanity of this thing, right?
Oh, great. Well, let me ask you this question because, family member, married, you talked about, dual citizenship and that in a foreign country, not Canada, for example, without getting into too much detail, and you may be able to answer this theoretically based on what your knowledge is about Canada. I live in the United States. I meet somebody from Europe, for example, and we marry. Is that person dual citizenship in the United States and subject by any income that they make in the United States, subject to taxation by the Internal Revenue Service?
Well, okay. Let's start from the principle that all U.S. source income is taxable to whoever earns it, right? So, let's start from that principle. So, I think perhaps what you're really asking is, you marry somebody in Europe, they continue living in Europe. Is that?
Well, they come back. They're earning some money in the States, but primarily we're living in Europe.
Well, if you're primarily living in Europe, okay, if there's no U.S. source income, then no, of course not, because U.S. tax residents are one of three kinds of people, okay? Citizens,
right.
Green card holders, meaning permanent residents, or those who meet the substantial presence test.
Right.
So no, they would not be required to file, all right? However, if you're living in the United States, I think it's more likely that you might use an election under the Internal Revenue Code, which is found in sections, I think it's 6013G, which allows you to file jointly with a non-resident alien spouse. All right. Now, why would somebody do that? Well, I think it's a pretty good bet that the non-resident alien spouse has no income, right? Because you make that election, then all the income of the comes into the system, and it would do one of two things, right? It would either lower the get you into a lower tax bracket, or possibly lower the threshold for certain reporting requirements. It can be done. I think it's a very bad idea to do it without knowing what the exit strategy is before you do it.
Right.
Because it continues until you make a specific election. All right.
Well, John, I got something came to my mind while you were mentioning that about living in Europe and working, one of the two working in the United States occasionally, or earning money from say a multinational corporation. What would be in the work that you do in Canada and you help people, what would be the most complex transaction that you've had to deal with in your line of work, dealing with the Internal Revenue Service or dealing with taxes for somebody that lives in Canada?
I think it's probably almost the same answer anywhere, and that is, when people run small businesses through things that are deemed by the Treasury regulations as corporations, and turn out being CFCs, controlled foreign corporations. I mean, it is beyond insane. For years they've had what's called, the reason it's a problem is this, okay? It's because the whole purpose of the CFC rules is to essentially pierce the corporate veil and attribute income earned inside the corporation to the individual, even though it hasn't been distributed, right? So this can set people up for pure double taxation, right? Because, let's imagine, traditionally, an investment portfolio would be called subpart F income, which means that the income earned by the corporation from the investment portfolio is taxed to the individual, okay, without a distribution. Well, this is a problem because at some point it's distributed in Canada, at which it becomes subject to Canadian taxation, right? So right. You're really set up for double taxation. And since the 2017 Tax Cuts and Jobs Act, two things happened. Up until then, it was mainly an investment income type of problem. But what they did was they said, nah, taxing the investment income is not good enough. We want to go after all the income, right?
Oh, mercy.
Yeah. So they did two things. The first is they put get this, okay? I'm not making this up, by the way, all right? You don't have to make anything up. This stuff is
right. Everything the IRS does is just right up here with the level of unbelievability.
This was Congress, but in any case, what they did was they imposed, get this, a retroactive tax in these CFCs on 35 years of earnings. Can you imagine?
Wow.
So I had a call from this Canadian doctor who was in his 60s and had just retired, and
oh my God.
This is normal stuff, right? To use these as pension plans. That's how they're designed to work in Canada. So he's got, what really is a modest amount of maybe $3 or $4 million. It's a modest amount for all those years.
He's worked half his life. He got out of med school and now he's.
That's right. It's modest, okay?
30 years or so.
He's ready to retire. And all of a sudden, boom. Okay. They want what turned it out to be, you run the numbers, it would have been 17.54% haircut on that. But the question is, where does the money come from, right? Now, there were wrinkles, okay, that you could pay it over 8 years, et cetera. But the point is that it was nothing but a pure confiscation through a retroactive tax on income that was not taxed by the United States the time that it was earned.
The first go round.
That's right.
35 years earlier.
That's right. That's right. And right up to 2016. All right.
And the complexities are there for people living overseas that have United States citizens. What about Windsor? We always hear about Detroit and Windsor, because at that border crossing, do people go to the CVS in the United States and pick up medication and then drive back over to Windsor, or or somebody working lives in Detroit and works in Windsor? You don't have to have a citizenship in Canada to go work in Windsor, do you, if you live in Detroit? Taxation.
Well, there's a lot of back and forth across the border, right? There's no question about it. There are different kinds of visas, et cetera. You can even have a green card, which is called a commuter green card.
I know. Somebody drives a produce truck back and forth every day. There
is and has always been a lot of back and forth between Windsor and Detroit. The Ambassador Bridge is one of the main trade arteries, right?
Right.
You know, between the two countries, you know, as you may know, and there's the tunnel. You know, there's a lot of the tremendous number of dual citizens living in Windsor. In fact, there are so many dual citizens living in Windsor. In the last election, Democrats abroad had these billboards on the side of Windsor public transit buses. If you can imagine.
Wow. All right. Well, gentlemen, our time is kind of slipping away from us. We got a little under 3 minutes to go. John, I'd like you to comment, if you would, what the effect would be if we could, as we say here on FAIRtax Power Radio a lot, rip the entire Internal Revenue Code out by the roots and replace it with the fair tax, a consumption tax that's levied only on the retail purchase of new goods and services within the United States. Would that solve all your problems?
That would absolutely solve all the problems because, one, there would be no income tax. Two, one way to look at the fair tax, it moves the U.S. to a territorial tax system, meaning it's only taxing activity that's going on in the United States. So there's no question that all Americans abroad should be out there supporting the fair tax movement, absolutely, positively, if they want to keep their citizenship, right?
Do you have a mailing list by any chance that we could send some?
Well, I mean, you know, I don't actually have a mailing list myself, but I can put you in touch with people who, you know, presumably do. I mean actually,
yeah. And the whole thing is that we're on this treadmill. And we move forward and we talk to people, and it's always one of those, hey, come be a part of what we're doing. And to be able to encourage wherever the interest group is, whether it's expatriates or whether it's you know, a group of the working poor, for example, who would benefit greatly from, you were working 3 jobs, and one of the jobs is to pay for the gas, and the second job is to pay for the taxes, and the third job is to pay for the food. And, you know, so we have these groups of people that rally around this concept. And I'm excited to be able to sit and speak with you today because you're in a position that I haven't considered. Somebody living overseas would be just like exploding with excitement because of what the tax on consumption through the fair tax would actually do, and like that, without any consideration. And so the pressure needs to be put on the politicians, and from wherever we can get that pressure to get people in the right position, in the right seats in the halls of Congress to make this happen.
Absolutely. I mean, I certainly, I'm not, you know, I'm not sort of out there in Facebook groups and stuff like that, right? But there is no doubt in my mind that every U.S. citizen living outside the United States should not only be supportive of the fair tax, but should be visibly supportive of the fair tax, and ought to be, you know, you ought to like turn it into almost like an MLM marketing system outside the United States. That's what I would do. I mean, I would get fair tax. You know what you need is you need fair tax abroad. You actually needed, I'm serious.
I'm writing that down.
Vision of this thing, and you need at least an initial. I mean, you can use my name if you want me to be the you know, initial point person for fair tax abroad or something, you know, whatever we're talking about. But, you know, really, it's a great opportunity for you. Democrats abroad are making noises, you know, that somehow the vote from overseas influenced the last election. Maybe that's true. Maybe it's not.
If the vote from overseas knew which candidates supported the fair tax and which ones didn't, then maybe we could make an impact that way.
We have people tell us that we need a fair tax president, that, you know, once the right people get into the halls of Congress, then the next thing that comes out of their mouth is you need a person in the White House that's going to be able to say, hey, here we go. Let's get it to my desk. I'll sign it.
You know, I wrote a blog post a day or two ago. I don't know if you saw it or not, but, you know, beyond the tax thing, the U.S. has got to get rid of the Internal Revenue Code for a very simple reason, okay, that is gotten so tyrannical. All right. Nobody even knows what they're required to do, that You know, in 1981, President Reagan made one of the greatest inauguration speeches I've ever seen, right? Where, you know, he talks, you know, where there are two sort of points, right? He talks about, at least as an aspiration, the freedom and dignity of the individual. I mean, the bottom line is the U.S. tax system has basically enslaved all Americans. The way, you know, the way
it's common to everybody, not just the expatriates.
Absolutely, right. Absolutely, everybody. Okay, and the second is that, you know, very early in the speech, he says something like, let us take stock of where we are. And then he says, we are a nation that has a government, not the other way around. And at the moment, this tax stuff has gotten so insane that I think that actually the Internal Revenue Code has replaced the Constitution as the Constitution.
Well,
I mean, you know, everything's
been used for nefarious activities for both parties.
Exactly. So, you know, I think that, I mean, the Internal Revenue Code has to go. Yes, I agree with the fair tax thing, but I think the argument for the fair tax thing is far more than just the fair tax makes sense economically. I think the argument should include to restore the dignity of the individual.
Right. Liberty and freedom.
Liberty and freedom. Absolutely.
Well, guys, we've run a bit long here, but it's been worth it.
Yes,
John, again, we certainly appreciate your time talking with us. And it sounds like that if we can get the fair tax message to your constituency out there, that we might be able to move the ball down the field a little bit farther.
You have nothing to lose. There's only gains, only gains. All they have to do is understand that they'll no longer be U.S. tax residents, and you are golden.
And then you don't have to renounce your citizenship, and that
That's
is going
right.
And that is going to wrap it.
If you want
to go ahead.
If you want to keep your U.S. citizenship, support the fair tax movement.
Excellent. And that is going to have to wrap up this edition of Fair Tax Power Radio. Thank you so much for watching and listening. I'm Bob Paxton.
I'm Bob Scarborough.
And in the middle is John Richardson, reminding you, as we always do, that the fair tax is the only truly fair tax. And once you understand it,
you'll demand it.
So, how much will I bring home?
Go ahead.
How much do you make? What'd you say, 40,000? Okay, keep it simple, throw out the deductions, all that stuff. So, you got your 40K, right? Now the first 8,000 is going to be taxed at 10%. The 8 to 33,000 is going to be taxed at 15%. And the 33 to 40, of course, is 25%. So that brings your total to $6,345.
Okay, so the average is what?
16%. Okay, and then on top of that, you got Medicare, which is 1.5%, and then of course your Social Security, which is 6.2%. So actually, your new total is $9,405.
Which is
23.65%. You're getting it. You're getting it. Don't even get me started on what the boss has to pay. He's got to pay a portion of your taxes as well, so you don't have to.
Right. And you?